Undies $600 million, gone in hours. No explosions, no alarms, no masked criminals running through bank doors. Instead, a silent digital exploit drained hundreds of millions of dollars shall live on the blockchain for the world to witness. At first, it looked like a glitch, then another transaction hit, then another. Millions moving across chains. Ethereum, Binance Smart Chain, Polygon. Within hours, it became the largest decentralized finance exploit ever recorded. But this wasn't just about money, it was about vulnerability, because the vault wasn't steel, it was software, and software, no matter how advanced, is written by humans. This is the story of how one logical flaw nearly collapses trust in an entire financial movement, and why the hacker gave most of it back. To understand how this heist happened, we need to understand DeFi. Decentralized finance was built as an alternative to traditional banking. No banks, no intermediaries, no centralized control. Instead, smart contracts run everything automatically. Investors deposit crypto assets into liquidity pools. Borrowers take loans. Traders swap tokens instantly, all governed by code. By 2021, billions of dollars were locked in these systems. The promise was simple. Trust mathematics, not institutions. But that promise came with a risk few fully understood. For centuries, banks relied on human oversight. Managers approved transactions. Auditors check balances. Security teams monitor fraud. In DeFi, none of that exists. The smart contract executes exactly as written. If a rule says transfer funds, it transfers them. It does not question intent. It does not detect emotion. It does not hesitate. That efficiency makes DeFi powerful, but it also makes it unforgiving. One logical mistake can become catastrophic. The platform attacked was a cross-chain DeFi protocol. Its purpose was to allow assets to move between different blockchains. This required complex bridging mechanisms, and complexity often hides risk. The protocol held hundreds of millions in liquidity. Audits had been performed. Security checks completed. Confidence was high. But audits reduce risk. They don't eliminate it. Somewhere inside that complex system, a weakness remained. The vulnerability wasn't dramatic. It wasn't obvious. It was subtle. A logic error in how transactions were validated. A function that verified asset transfers could be manipulated. By crafting specific transaction data, the attacker could trick the contract into approving transfers that shouldn't exist. The contract didn't know it was being deceived. It simply followed instructions. Because code doesn't interpret context, it executes commands. And the attacker understood this perfectly. How does someone discover such a flaw? Most likely through deep code analysis. DeFi protocols are often open source. Anyone can inspect them. The attacker may have reviewed the contract line by line, simulated edge case scenarios, tested transaction payload variations. This wasn't random. It required skill, patience, and technical precision, the kind that only comes from deep blockchain knowledge. The first abnormal transfer didn't raise alarms. It was small, but intentional, a test. When it succeeded, the attacker knew the vulnerability was real. Moments later, larger transactions followed, then larger still. Confidence grows quickly when systems don't resist. The exploit wasn't limited to one chain. The attacker executed synchronized drains across multiple blockchains. This multiplied the damage. Funds flowed rapidly into controlled wallets. Hundreds of millions transferred in hours. And still, nothing could stop it. DeFi is decentralized. There is no CEO who can reverse a transaction. No bank manager who can freeze an account. Once confirmed on the blockchain, it is final. That immutability is celebrated. But in this moment, it was terrifying. Blockchain explorers showed everything. Wallet balances rising, protocol balances collapsing. It was transparent theft. The world watched in real time, but visibility didn't equal control. Investors reacted immediately. Token prices dropped. Social media erupted. Developers issued emergency statements. Confidence cracked. Fear spreads fast in financial ecosystems. News outlets quickly picked up the story. Headlines screamed, "Largest DeFi hack in history. $600 million vanishes overnight." Mainstream media didn't fully understand the technical details, but the impact was clear. Investors panicked. Social media exploded. Crypto forums lit up with speculation. Every major exchange was monitoring the situation. Journalists called experts. Developers issued statements. Analysts warned the public. The story had gone global before the hacker even spoke. Then unexpectedly, a message appeared. Not on social media, not in an email, on the blockchain itself and embedded in the code. I am exposing a vulnerability. This is a lesson, not a theft. The message shocked everyone. Most hacks end in silence or extortion. This hacker had broken the unspoken rules. It immediately reframed the incident. Was this theft or was it an ethical warning? Speculation ran wild. Was this a white hat hacker? A security researcher testing the system? The hacker returned part of the funds in small amounts, almost like a demonstration. They wanted attention, but not maximum damage. Ethical debates erupted online. Some called it the most sophisticated proof of vulnerability ever. Others feared copycats. Can a thief ever truly be ethical? Instead of threats, the platform tried negotiation. They offered rewards for returning the remaining funds. A few million in bounty was trivial, but the gesture mattered. It became a delicate dance, hacker versus platform. Each move scrutinized, every transaction examined. The world was watching live. Slowly, funds began to trickle back. Wallet by wallet, investors were astonished. The hacker was keeping promises. Each return blurred the line between criminal and ethical hacker. Blockchain analytics firms jumped into action. Every transaction left a digital footprint. Patterns emerged. Analysts could track movement across wallets. Governments couldn't ignore this. Regulators issued warnings about DeFi. Billions were vulnerable to logic flaws. Policy discussions began. Industry standards started forming. Trust had been shaken. Investors questioned DeFi safety. Confidence in the platform dropped. Security reforms followed. It was a wake-up call. Cyber criminals watched closely. Could they replicate the method? Fear of copycats grew. It became a blueprint for digital thefts to come. The hacker had mastered fear. By draining millions in hours and returning some funds, they controlled perception. Investors felt both panic and relief. The psychological impact was intentional. Uncertainty and tension are powerful tools, even in finance. Crypto is often called anonymous, but it is pseudo-anonymous. Every transaction is traceable. Every movement can be analyzed. The hacker exploited the illusion of anonymity. Analysts proved that nothing is truly invisible. This heist became a landmark case in proving traceability. At its core, the exploit was simple logic manipulation. A function that should have blocked unusual transfers was bypassed. All it took, deep understanding of the contract architecture. No hacks on the blockchain itself. No breaking encryption. Pure logic. And that simplicity made it terrifying. Developers and investors learned critical lessons. Test every edge case. Assume attackers are watching. Trust audits, but verify independently. The heist became a case study worldwide. Was it a lone genius? An insider? A coordinated group? No one knows for sure. The hacker's execution suggested deep expertise. Experts agree, yes. The incident exposed systemic vulnerabilities. Other protocols could face similar attacks. The next heist may be larger, faster, more sophisticated. This heist marked a turning point. From $1 million scams to $600 million exploits. Cybercrime is scaling globally. Law enforcement is only beginning to catch up. Digital assets can vanish in hours. Unlike banks, there is no insurance. Wealth depends entirely on code quality. Digital finance offers speed and efficiency, but risk. The heist prompted innovations, multi-signature wallets, cross-chain security audits, real-time monitoring systems. Regulatory oversight increased. Digital finance must coexist with law enforcement. The most expensive digital heist didn't break vaults. It broke trust. It exposed the fragility of code-dependent finance. It served as a warning. The next heist may not return the money. The next attacker may be smarter, faster, more anonymous. The battlefield is digital, silent, relentless. The strongest vault is not steel, it's knowledge. And the next heist is already waiting. The most expensive digital heist in history didn't break a vault. It exposed a truth. Digital finance is powerful, efficient, revolutionary, But it is also fragile. Behind every billion-dollar protocol is human written logic, and logic can fail. The hacker didn't need force, they needed understanding, and in the future, understanding will be the most valuable weapon of all, because the next great heist may not return the money, and it may not announce itself. It may unfold silently, just like this one did.